This is an urgent update about what's happening in the market right now. AI stocks are selling off, Bitcoin is selling off, and this could be the start of a much bigger correction. Even if you don't care about Bitcoin, you should still watch this, because Bitcoin often acts as a leading indicator for what's about to happen next. It has started falling before the rest of the market, and historically, that's been a very important signal. There are a few theories explaining why this is happening, and each one is extremely interesting. The most fascinating one comes from a technical point of view, and I want to give full credit to Benjamin Cowan for this analysis. If you don't follow him, check out his YouTube channel. He breaks down market data in a way that just makes everything click. One of the most interesting things I learned from him is this. When the price of Bitcoin falls below something called the 50-week moving average, the bull cycle, the good times are over. That average price was roughly $13,000. We crossed that level a couple of weeks ago, triggering a wave of selling from investors who pay very close attention to this indicator. To them, it was like a prophecy being fulfilled. This move happened while everything still looked good for Bitcoin. We had regulatory clarity developing, more companies adding Bitcoin to their treasuries, positive news on legislation, and even major universities like Harvard buying hundreds of millions of dollars worth of it. Everything pointed up, but the price didn't follow. So why did it fall? And what could happen next? In this video, I'll share the most interesting theories about what might be happening behind the scenes, so you can get a clearer idea of what's coming. Eat that side. Let's jump into it. Hi, my name's Andre. Hope you're doing well. Come for the finance, stay for the market insights. Let's start with the technical side of the story, because I think it provides one of the strongest explanations. The idea behind technical analysis is that markets are social systems. When social systems follow certain patterns, they tend to trigger predictable behaviors. Let's use Bitcoin as an example, but remember, these principles apply to all kinds of investments. Take a look at this chart. It shows how long it took Bitcoin to go from the bottom of the market to the top. It took, roughly, 1,500 days for this cycle. But what's extremely interesting is that the last two cycles also took roughly 1,500 days. Now look at another chart. I know it looks complicated, but it shows something similar. Bitcoin has followed the same pattern, but it alternates between going from an all-time low to an all-time high, and then an all-time high to an all-time low. For example, in 2015, from the low to the high, it took about 1,500 days. Then in 2017, from the high to the low, it took 364 days. Then in 2018, from the low to the high, it took 1,500 days again. Then again, from the all-time high in 2021 to the all-time low, it took 364 days. Now guess how long it took from the all-time low of this cycle to the all-time high. Roughly 1,500 to 1,640 days. Which means, if this pattern continues and that's a big if we should reach the next all-time low around 364 days from our last all-time high, which happened on October 6th of this year. That points to around October 5th, 2026, as a possible bottom. Now, do I think these exact dates are guaranteed? Not necessarily. But is it an interesting pattern we should pay attention to? Absolutely. Markets are driven by human psychology, and humans behave in patterns, whether we realize it or not. Now, let's talk about another important part of technical analysis, the 50-week moving average. If you take the average closing price of Bitcoin over the last 50 weeks, you get a line on the chart. Historically, whenever Bitcoin was in a bull market, it stayed above that line, and whenever it fell below that line, the bull market was over, and the bear market began. Recently, we broke below that level and stayed there for several weeks. That price level was around $13,000, and ever since crossing that line, Bitcoin has struggled to recover. This isn't random. Investors who believe in technical analysis use indicators like this to make decisions. Many algorithms also use this as a trigger to automatically sell. So when we went below that average, it created a cascade, a chain reaction. And that brings us to the next part of the story. This theory suggests that what's happening now has nothing to do with charts and everything to do with global economics. Let's start with Japan. Why does Japan matter? Because the global financial system works like this. The United States exports technology and the US dollar. China is the factory of the world, and Japan used to export free money. Their interest rates were zero, sometimes even negative. This allowed for something called the carry trade. Investors would borrow Japanese yen at low rates, convert it to dollars, and invest it in US assets for a profit. Free money, low risk, huge leverage. But now, Japan's interest rates are rising. The carry trade is unwinding, and that means money is flowing out of dollar-denominated assets and back home, because now, keeping money in Japan finally makes sense. There's also a second liquidity shift, and this one came from the Federal Reserve. The Fed recently announced that on December 1st, they will end quantitative tightening, or QT. That sounds like good news at first, but historically, when QT ends, it signals that something might be breaking behind the scenes. Investors are nervous. They don't trust the Fed. They see slowing job growth, consumer spending held up by only the wealthiest people, and AI stocks that might have been propped up by easy money. So what do investors do? They sell risk assets. They wait. And Bitcoin, being the most liquid, is usually the first to react. It can be sold 24/7, even on weekends. Unlike real estate or bonds, Bitcoin doesn't sleep, and that's why it often moves first. It is the canary in the coal mine. So, from this point of view, the charts aren't causing anything. They are simply reflecting investor fear. There's another theory, and this one comes from inside the Bitcoin community. Recently, there has been a battle over the identity of Bitcoin. What is it supposed to be? Pure money, or a system for storing any kind of data like NFTs, pictures, and documents. A recent update has allowed bigger data to be stored inside Bitcoin transactions, and that has opened the door to something some investors really don't like. They fear Bitcoin could become overloaded with non-financial data, which increases the block size, makes nodes harder to run, and could even be exploited. This creates a psychological shift. If Bitcoin's identity is unclear, some investors prefer to wait on the sidelines. Markets don't like uncertainty, and this internal conflict may be contributing to the selling pressure. This final theory ties everything together, and I think it's incredibly interesting. According to investor Jordi Visser, Bitcoin is now experiencing the equivalent of an IPO. Not literally. Of course, Bitcoin isn't a company, but what he means is this. There are early investors, OG Bitcoiners, who bought it for nearly nothing. Until recently, they couldn't sell their entire position because there wasn't enough liquidity. But today, there are ETFs, hedge funds, corporations, even countries buying Bitcoin. For the first time ever, the earliest investors can actually sell without crashing the price entirely. For example, earlier this year, a $9 billion Bitcoin sale was processed from just one single wallet. That was not possible a few years ago. So this theory says this is Bitcoin's moment of maturity. Old investors are exiting. New investors are entering. This could take a full year or longer, but it is a major transfer of wealth from early adopters to the masses. So what am I doing? As for me, I'm not selling my Bitcoin. I think that regardless of internal or external challenges, Bitcoin will eventually recover. Its financial incentives will realign, because they always do. I'm also not selling my long-term stock portfolio. My dividend portfolio continues to pay me every single month. And in sideways markets, that income becomes even more valuable. If inflation rises or the market drops, dividend cash flow becomes a form of protection. Will any of these theories turn out to be exactly right? I don't know. Can all of them be partly true? Absolutely. If this were an index fund of truths, each theory would carry a different weight, and that weight could shift over time. The best we can do is stay informed, remain diversified, and emotionally stable. Because here, that's what I believe. The biggest fortunes are not made at the top of the market. They are made near the bottom, when fear is at its highest. So whatever happens next, I'm staying in the game. Thank you for watching. If you enjoyed this breakdown, let me know your thoughts in the comments, and subscribe for more insights every week. Stay smart, stay focused, and I'll see you in the next video.